$100,000 a year. Most people think that number ends the financial stress. The data says most people just upgraded. Same anxiety, better furniture. We are going to do the breakdown nobody does. Not what you earn, what you actually keep, and what the gap between those two numbers costs you over the next 30 years. Start with what leaves before you see it: federal income tax, FICA, state tax. On a $100,000 salary, the combined effective rate runs between 28 and 32%, depending on your state. You are not earning $100,000. You are keeping roughly $70,000. That is the first reframe, and most people have never fully made it. Now the fixed costs: housing, transportation, food, insurance. These are not optional. They leave every month, regardless of what you decide. The Bureau of Labor Statistics tracks actual spending for households in this income range. When you add those four categories together, conservatively, you are looking at roughly $48,000 per year. Subtract that from $70,000, you have approximately $22,000 left, less than $1,900 per month for everything else. That is not a rounding error. That is the actual financial reality of a $100,000 income in the current cost environment. Now lifestyle spending starts. Utilities, phone, subscriptions, clothing, entertainment. The spending that feels small in the moment and adds up to roughly $11,000 per year when you actually track it. What remains after lifestyle, around $10,000 per year, $833 per month. I find this number striking every time I run it, not because it is surprising, but because it matches what people actually report. The Federal Reserve data consistently shows that a significant portion of households earning above $75,000 report difficulty saving. The math is the explanation. That $833 is before debt service. If you are carrying a student loan, a car payment above average, or any credit card balance, that number goes negative. The income is real. The margin is not. Here is the part that compounds. $500 per month redirected into a low-cost index fund at age 30 becomes $567,000 by age 60. At 7% real annual return. 30 years. That money exists in the math right now. It just never gets there, because the lifestyle layer absorbed it first. The $100,000 lifestyle is not just expensive today, it is expensive in the future, at a scale most people never calculate. 3 decisions change this breakdown significantly. Housing below 25% of gross instead of 30 recovers roughly $5,000 per year. 1 decision, entire breakdown restructured. A paid-off used vehicle instead of a financed one eliminates up to $600 per month in payments. We ran that math in week 4. And friction-based lifestyle reduction, not elimination, not deprivation, cuts the lifestyle layer by 15 to 20% without triggering the rebound we covered in week 10. None of these require earning more. They require seeing the breakdown clearly first. Most people track gross income. That is the least useful number in this analysis. The number that matters is your actual financial margin, what remains after taxes, fixed costs, and lifestyle. The number that either compounds or disappears. Calculate yours. Drop it in the comments. I want to map where Finance Deciphered viewers actually stand, and I will use the data in a future video. Finance Deciphered Lab. New video every Tuesday. Everyone starts with the evidence.